Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a live show, of course, for you on Saturdays, Sundays, in addition to my live radio show. Make sure that you visit our website, ReznyWealth.com, and always send us your questions to Brian Rezny at ReznyWealth.com. You know, I want to talk a little bit about the economy today and market corrections and what really hurts investor portfolios and your ultimate return and really sacrifices your retirement. Back in August, September, we saw roughly about a 10% correction in the equity markets. Some investors sold, some investors added when appropriate. But if you were one of those emotional investors when your money went down temporarily and you sold at the bottom, big mistake. Too often, too many investors make emotional decisions. For some reason, when there's sales at the grocery store, people will buy. But if there's a discount in the equity markets or the stock market temporarily comes down, people will want to often sell instead of adding new good positions in their portfolio. Emotions are going to hurt you. Not following an investment strategy or principles is going to ruin your return. And too often, I've been doing this for 30 years, and too often I see a lot of investors make these emotional mistakes time and time again. Remember this. If we actually have a recession or there are signs of recession, like in the year 2000 or 2008, yes, it's appropriate when things are really slowing and the economy is doing poorly to start raising cash and get conservative. That's important risk management. But to think that you're going to bounce in and out of the market every little bounce that we have or small time correction is really a fool's game, and it's going to ruin your returns. In August, September, there were no changes to the fundamentals in the U.S. economy. In fact, I called for a garden variety correction sometime this year, around 8 to 10%, and we had it. That was a great time to actually add cash that you were holding into new equity-based positions, not to actually sell. So remember, recessions or signs of recession and a real slowing economy is a reason to sell. Not every little downdraft or small-time correction that's going to hurt your portfolio. As an investor, you need to realize bumps in the road are a natural part of the investing process. But today, I want to talk about the most important thing to you, the investor. This is something I've educated investors about for the last 30 years, and it's a fiduciary standard of care versus the suitability standard of care. And why should you care, and how does that affect your portfolio ultimately? Well, let me tell you this. Most investors hire salespeople and not real money managers to manage their money. They jump from Wall Street firm to Wall Street firm to bank person to annuity sales guy over and over again looking for the promised land. The problem is you're hiring salespeople working for Wall Street banks or insurance companies that are really no more than salespeople for the products they have to sell and are required to sell. Their interests are different than yours. Fact, fiduciary standard of care. Fee-only registered investment advisory firms like Rezny Wealth Management adhere to what's called the fiduciary standard, have a legal obligation to act in the client's best interest, and we actually manage your portfolio. Fact, suitability, which is the vast majority of so-called advisors, well over 90%, basically sell investment products that they are required to sell through their brokerage firm, bank, or insurance company. At the end of the day, if somebody is selling you a product, they're not managing your money. The problem that most investors face is they do not know how to pick the right advisor because most of these people wear a suit and they give a pretty good slick presentation. You, the investor, are responsible to make sure that your money is safeguarded. And if you're looking for real money management, which includes risk management and not sales, then only hire a fiduciary fee-only firm. This disclosure often shows up on brokerage new account forms that you signed as the investor. And it basically states right there in black and white that you have a brokerage account, not an advisory account. This is the crux of the problem. Brokerage is sales, advisory is actual money management. And often, if you're working with these brokerage firms, it tells you right in that disclosure, you're working with a salesman and their interests are far different than yours. So remember this, folks. Fiduciary standard of care is what you want. Suitability is what you want to avoid. Only hire fee-only fiduciary firms if you are looking for money management and not sales. Remember, Wall Street's not your friend. The local person at the bank sitting there waiting for your big deposit, or the guy trying to sell you the annuity of the month at the free steak dinner seminar, not your friend. Do your homework. Do a little investigative reporting. Better yet, go to my website, reznywealth.com, and for free, you can download our free questionnaire, Fiduciary versus Suitability. It's right on the homepage. It's free, and it's a valuable tool, so it'll help you pick the right person or firm to actually manage your money and control the risk within your investment portfolio. Avoid these salespeople. Stockbrokers. By the way, back in the day, stockbrokers were called stockbrokers. Today they're called financial advisors. Watch out for insurance agents, people selling annuities, financial consultants, people that use slick titles like wealth manager or registered representative. These people all benefit from selling you investments their firms represent for commissions. Again, look for a fee-only fiduciary money management firm. Fiduciary Registered Investment Advisor Questionnaire. Go to reznywealth.com. I talked about this earlier. This particular questionnaire that my firm has put together is free. It's a valuable tool. If you are suspecting that your current so-called advisor is actually just a salesman, use that questionnaire. Find out if that firm actually manages your money or they're just there to sell you and earn a commission, and your retirement portfolio is sent to the back of the line. Rob from Naples, Florida. Is Caterpillar taking the right steps? Would you buy the stock? Rob, that's a great question. And by the way, folks, send your questions to Brian Rezny at reznywealth.com or visit my website, reznywealth.com. Rob, the question on Caterpillar is simple. I would not buy the stock, and for really two main reasons. Reason number one, fundamentally, Caterpillar is not necessarily a cheap stock fundamentally, and they have deteriorating fundamentals, meaning the fundamentals, the quality of the earnings and their sales are in a vast decrease over the last 3 to 5 years. A lot of that is due because of the emerging market economies. Why Caterpillar is a great company, it is not a good investment at this time. So fundamentally, the earnings are going down. Stocks react to earnings. If earnings are going up, often stock prices go up along with it. When earnings are coming down and are in retreat, stock prices go down along with it. Also, on the technical side, if we look at some of the basic technical moving averages, let's say the 35-day or the 100 or 200-day moving average, you look at Caterpillar long term, it's in a very negative downtrend. Never buy a stock that is going down in earnings, and never buy an investment that is relatively weak against the broad market indices. If you do, it's usually a recipe for further declines and poor performance in your portfolio. Caterpillar should be sold and not bought, in our opinion. Sam in Fort Myers, Florida. Where are the best opportunities in preferred shares? Sam, first off, let me explain to all of our listeners what preferred shares are. There's common stock and preferred stock. Preferred stock is kind of a hybrid between stock and bonds and often pays a higher dividend normally than the common stock does. But what I would tell you is this. Janet Yellen just recently gave her testimony and essentially said rates, if the economy continues on this stable footing, rates will probably go up. Since preferreds act like bonds or long-term bonds, preferred stocks will probably not do that well and probably will lose money over the next 3 to 5 years, simply because if the economy does well, as the Federal Reserve is looking for, interest rates will move up and preferred shares often will come down or stay flat. So I would tell you I would avoid preferred stocks at this point. What I would rather have you do is look for inexpensive ETFs, exchange-traded funds that are better diversified, that you can put your money into where you can get a potential dividend and a growth, so you get total return on your portfolio. Avoid preferred stocks and a couple other areas on our hit list to avoid right now. Long-term bonds, including government treasuries, long-term muni bonds, this would be any bond that has an average 5-year maturity or higher. And if you own mutual funds that buy bonds that have an average maturity of 5 years or higher, these should be sold and should be avoided because, again, rates go up, bond values ultimately come down, and it's going to hurt your portfolio. I want to talk about a little bit of a strategy about total return and what that really means to you and to the investor. Total return on an investment means the dividend you receive and the growth or gain or loss of that particular investment. Total return is important. In fact, let me explain why. If we look at the stock market, the S&P 500, over the last 10, 20, 30 years, about 20 to 30% of the return of that major index, the U.S. stock market, was made by dividend. The other portion of the return, about 70% of the return, was made from the growth of principal. Dividend is important. It pays you money today in order to live while your asset has a chance over the next 3 to 5 years to appreciate. Remember total return. It's a great strategy when building a portfolio. Unfortunately, what I often see with most investors is they don't understand total return, or their broker is selling them things that are going down in value, and they're selling them things that just have high yield, but they're losing principal at a faster rate than the dividend. Watch out for investments that are in a downtrend and look for total return opportunities to better your portfolio. Jeff from Miami, Florida. The S&P death cross, time to panic. Well, first off, Jeff, I will tell you this. The S&P, or the death cross, is basically when the 50-day moving average crosses below or above the 200-day moving average of any investment. And if you're talking about the S&P 500, what I will tell you is this. The death cross, while it sounds scary or potentially good on a rebound, there's been a lot of research on this. Long-term moving averages don't work all the time. In fact, it's about a 50-50 mix. Sometimes they work and sometimes they don't. So ultimately this, I have found personally that when we get these short-term corrections, like we saw back in August and September, we actually had that death cross. The 50-day cross below the 200-day moving average of the S&P 500. Was it a time to sell? Absolutely not, and I'll tell you why. There were no changes in fundamentals. It was more of the garden variety correction. Remember, corrections happen for various reasons, often because of emotion. And what spurred that correction back in August, September was China's GDP slowing down a little bit. The world wasn't coming to an end, but the market overreacted, as it always does. It overreacts to the downside, and then of course you had this basically full recoup back to the upside. If you sold when the death cross actually happened, you would have basically sold close to the bottom of that correction, and then you would have lost probably a 10 to 12% return back to your original principal. Death crosses don't work that well, and I would not use that as your only investment tool. I'm going to take a short break. Send your questions to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. And we're back. I hope you're enjoying today's program. Make sure you do visit our website, ReznyWealth.com. We do have a number of workshops, educational workshops around investing, how to be a successful investor, and ultimately how to protect your portfolio. Our workshops are entitled Adapt for Success. Go to my website, reznywealth.com, for times and availability, and also to sign up. One of the things I want to discuss before I go to my next question is about asset allocation. You know, I've been managing money for close to 30 years. One of the strategies, and I really don't like to call it a strategy, is called what's called asset allocation. You get that pie-shaped, colorful chart that shows up on your brokerage statements every month. And basically, asset allocation is a semi-quasi investment strategy pushed by Wall Street and banks. And what it basically does is they tell you, put your money all over the pie, meaning a little bit here and a little bit there. The problem with that is asset allocation has been a very, very poor investment strategy for many investors. I would say routinely, every week I probably talk to 2 or 3 investors who were pushed asset allocation or that failed pie by their brokerage firm, and they've had miserable results over the last 3, 4, 5, 10 years. They tell me things like, boy, Brian, I heard that the market's gone up 100% in the last 5 years, but my asset allocation pie has only gone up 10%. The reason for that is simple. Asset allocation, you don't want to own all the assets all the time because there's relatively weak assets that are not appropriate for this particular market environment. So what happens is you own weak investments that drag down the portfolio and the ones that actually hold things up. But at the end of the day, you don't make any money. They tell you it's for risk management, but at the end of the day, you still go up and down when the market goes up and down. So asset allocation is really a flawed, failed approach pushed by Wall Street and banks. We don't like it. We don't believe it works. We believe you should own assets that are relatively strong and sell assets that are relatively weak. That means technically and fundamentally. A couple assets that have been really poor performers the last 5 years has been gold and commodities, because we've had kind of low inflation or disinflation. And if you keep owning commodities in your portfolio or gold, it's dragged down significantly your returns. Don't think that loss can stop. It can continue for decades and decades. So asset allocation, in our opinion, doesn't work. What is a better strategy is relative strength, selling relative weak assets in a rising environment and an economic strong environment also. Sandy from Boca Raton, Florida. I own shares of IBB. What do you think of biotech? Sandy, great question. IBB is the iShares Biotech ETF. An ETF, folks, is an exchange-traded fund. So instead of buying 1 stock or 2 stocks, you can buy the IBB. It owns a broad basket of well over 30 to 40 biotech stocks. So you don't have to worry about being an expert on each stock. You just have to know, hey, I like biotech. Earnings are growing, there's good demand, technically it looks good, and it's relatively strong. If those fall into those categories, you may want to own the IBB. I will tell you this, over the last 5 years, the biotech area has done exceptionally well. It's been very volatile as of the last 6 or so months, but I would tell you, if you look at the long-term trends of the overall world economies. Of course, medicine is going to be a big driver of that, and I think biotech's also. Another ETF you may want to look at that's not as volatile as IBB is the XLV. That's the iShares Healthcare ETF. Fair disclosure, we currently do own that in managed accounts at Rezny Wealth Management. It's not as volatile as the IBB. It's done exceptionally well. That's no guarantee to the future, but it might be one you might want to look at for a little bit more broad-based diversification and still potential for that upside. Tom from Cape Coral, Florida. iShares MS Canada EWC. Tom, I don't know if you own this or you're asking if you should buy it, but I would not buy it, and I'll tell you why. First off, if you take a look at Canada, the way north part of our continent, Canada's performance, generally speaking, is really driven by oil. They sell a lot of oil, they produce a lot of oil, and generally speaking, Canada, that ETF has done very, very, very poorly the last 3, 5, and 10 years. I would rather see you be more broad-based in the U.S., better diversification. The U.S. marketplace actually has done better fundamentally. I like it better. I would avoid Canada, and I would not buy EWC at all. Terry from Naples, Florida. Do you think rates will go up next year? What effect will that have on bonds? Terry, yes, I firmly believe interest rates will go up as we enter 2016, but I think they're going to go up very, very slow. The Fed, Janet Yellen, has basically stated that it's going to be data dependent. There's not a mechanical method where they're going to basically raise every quarter or every particular time frame. They're going to look at the actual data. Their big drivers are inflation and unemployment. And they're going to look at those two drivers, and if they feel it's time to raise rates, they're going to. I firmly believe that the economy is doing well. From their testimony, the economy is doing well. And that doesn't mean that might not change in 6 months. So you have to be adaptive in your strategy and be ready to have risk management in play when necessary. But I think rates are going to go up. Bonds are going to get hurt. Remember, when rates go up, bond values go down. It's a teeter-totter effect. Unfortunately, bonds were a big driver of return the last 15 years or so. So a lot of investors who bought bonds 10 or 15 years ago have done pretty darn good. The problem is they think bonds will always make that kind of return, but they can't, because rates came from 10% down to 2%. As those rates came down, bond values went up, so your total return was quite excellent. You're not going to see that in the future. In fact, if I look at the next 5 to 10 years, I think bonds in general on a total return basis are going to be somewhere between negative 2% to maybe positive 2% on an annualized return going forward. They're going to be very poor performers because most of the rates are already pushed down. As rates slowly move up, bonds lose their value, and so does your total return. Phil from Cape Coral, Florida. What do you think of the Hatteras Alpha Hedge Strategy, APHAX? Phil, I've received a number of questions on that particular mutual fund, and it is a mutual fund, on my TV and my radio show over the years. I would not own that mutual fund with a 10-foot pole. I would sell it immediately. That fund has done poorly 1 year, 3 years, 5 years, and basically since its existence. The annual expense ratio of that mutual fund is somewhere north of 3.5% a year, or something close to that. It's supposed to hedge risk, but when the markets do well, it doesn't do that great. When the markets go down, it doesn't do that great. And if you look at how that fund is done in comparison to other investments like broad-based indexes, it's done horrifically poor. I would sell it if you do own it, and if you're thinking about buying, think it again, do better research, don't touch it, look at other areas of the market for a better potential return. And from Bonita Springs, Florida. Can you explain how bonds work, please? I find them very confusing. And I had a question earlier about bonds, and I could tell you, if you're confused about bonds, a lot of investors feel the same way. Investors tend to buy bonds because of the interest they pay or the dividend. And you have to remember, when interest rates go up, bond values go down. It's a teeter-totter effect. So again, Jimmy Carter days, 20 years ago, rates have come down, bonds went up in value, investors were well rewarded. Today, you have about a 2%, 2.25% rate on the 10-year Treasury. Rates can't go down 10% again because they're already around 2%. So that means that the chance for a gain or total return in a bond portfolio is going to be non-existent. As I answered that question earlier, if you look at the next 5 to 10 years, I firmly believe bonds are either going to be negative 2% to positive 2%, somewhere in that range. Very poor returns going forward in general. So you as an investor, if you do own bonds, it is important that you review your bond holdings with somebody who has the knowledge to do so. You can always call my firm, Rezny Wealth Management, and schedule a consultation. Let's take a look at your bonds and see, should some of these be sold for capital gain and lock in potential profit before you lose more money? Maybe it's the right time to start selling bonds or reducing maturity level of your bonds or the types of bonds you ultimately own. Bill from Naples, Florida. What does return of capital mean with closed-end mutual funds? Bill, that's a great question. Closed-end mutual funds are complex investments, more complex than a general mutual fund. Return of capital means you're getting your own capital back as part of the dividend stream. What does that mean? Let's say you bought ABC closed-end mutual fund and it's paying an 8% distribution rate. Well, you're like, wow, that sounds pretty darn good. But it's a distribution, not an actual dividend. That distribution might be 8% a year, 2% might be coming from dividend, 6% might be coming from your actual capital being liquidated, and they keep paying you that back. A lot of closed-end funds use that strategy, in my opinion, to sell those investments to the unsuspecting investor who does not understand return of capital. Any investment, and closed-end funds are really bad for doing this, in my personal opinion. Any investment that's paying 6, 7, 8, 9, 10, 12% distribution rates should be suspect and should have further research. Not every closed-end fund is paying return of capital, but a lot of them are. So understand, return of capital isn't return on investment, it's your own money back. So as your money goes down in value and you keep getting this 8%, eventually your capital might be zero and you're not going to be a happy camper. I would avoid most closed-end funds simply for that reason, and because a lot of them use leverage to try and pump up returns, which actually increases risk and ultimately takes away your money. You know, folks, I'm close to out of time. As I always tell investors, go to my website, ReznyWealth.com. Schedule a consultation. If you're finding that the returns that you feel are appropriate for your portfolio are not there, if you're finding that your current firm that you're utilizing is not a fiduciary money manager, if you're finding that you don't have risk management in play, how do you protect your money in the next recession? Call my firm for a consultation. If your portfolio is not performing the way it should, if you're truly not happy with the advice you're receiving, call my firm for a consultation. It's time you got a second opinion and you make sure that your portfolio is on track. Also, make sure you do listen to my other TV shows on Saturday and Sunday morning, and listen to my live radio show every Sunday morning throughout Florida from 10 a.m. to noon. Go to ReznyWealth.com for times of availability, and make sure you have yourself a safe and prosperous day.